Joining us now is Shalin, founder of Bodhi Tree Asset Management. Shalin is actually a quantitative macro portfolio manager they approaches markets in a little bit of different way. So we're interested to see how he does and what his models are telling him right now. Welcome to the show.
Thanks, guys. Thanks for having me.
So when you were kind of chatting with us and explaining what you do, I realized that you take a much different approach than most portfolio managers. And why don't you tell us a little bit about it?
Sure. Our strategy really emanates from kind of my 22 years in the as a professional investor in the alternative investment business. So I had an opportunity for the first half of that career to really work with a lot of external managers, hedge fund managers. I was early in the business, and I would invest with them, and I learned about their styles, about their biases, and the second half of my career was really more on the real money side, where I managed a substantial family office. I actually helped build out that program from scratch, and I did a lot of private investing and multi-asset class investing. And what I began to find as this cycle progressed was that the this need to be tactical was going to be a necessary feature of portfolio management in the future. Because if you think about markets today, and you're kind of seeing it actually happen in real time, a lot of the theories that we had, but we saw a lot of overvaluation, frankly, a bubble in private assets, particularly in venture capital, um, and and we saw very high valuations in across the board in general for even public assets. So if you think about that, what it means is that on a buy and hold basis for kind of in a family office or an endowment model portfolio, the returns are probably going to be very low going forward. But you could definitely have very large risk on, risk off moments across a number of different asset classes. So if you could do a better job in terms of trading these assets, that would be an important, something that'd be very important and very valuable for investors from not only a performance standpoint, but even a transparency standpoint, if you could give them that transparency.
Right. So are you going and putting these into models that you're monitoring on a daily basis and moving tactically as kind of markets become cheaper or expensive relative to one another?
That's exactly what we're trying to do. So it really just started off like any other quant model with one thing. We would trade S&P, and then if we didn't like it, we would go into bonds, and it was very, very simple. And that was kind of model 1.0. And then we began to realize that, well, if we could layer and add more features to this, and perhaps we would trade emerging markets, and now we could split that exposure in some sort of ratio between S&P and emerging markets. And then we said, oh, well, maybe we could trade Europe. And what we realized, though, was there was a commonality that drives a number of different asset classes, which I'm happy to go into. And so we just became a more of a data game, and that was the beauty of the world that we live in today, was the amount of data that's been made available to allow a macro trader like myself to hypothesize what's driving the world. And you see a lot of those, hypotheses, of course, on Twitter. You see a lot of different charts. But the question is, you know, do they have efficacy? Are they long lasting? Are these long lasting trends that would have done well 5 or 10 years ago, or do they even make sense? And
Right.
that's what we try to discern.
And it sounds a little bit like you set up the question, but did you find the Holy Grail, the one indicator that is the most important indicator in terms of allocating to these different asset classes?
Well, one of the things that I realized is that the more nuance you can get, the more precise your portfolio will be, and the more optimal your portfolio can be. And so, we do think that there are some really good indicators out there. We like, for instance, the ratio of copper to gold. That's something that's thrown out a lot, of course. But how you use those indicators and where you use them and what asset classes is extremely important, because with any model, this can be garbage in, garbage out, right? So the more precision you can get, the more of an optimal portfolio you can have for the given environment and regime that you're in. And that's
Okay, so what?
that's that's
So what?
that's really the holy grail.
So why don't you give us an example of how you use like the ratio of copper to gold to make asset
Sure,
allocations within your portfolio?
sure. So, um, have to be obviously very careful, because we are a hedge fund talking about performance, but we did pretty well in the fourth quarter of last year. Okay, and that was a very tough quarter. And as you recall, bond yields were rising. There was tremendous, bearish sentiment on fixed income in general, and we began to write not only on social media but to our clients as well that we were beginning to see an inflection in kind of the asymmetry of owning fixed income versus risk. We'll call it equities, just generically. And if you look at the ratio of copper to gold, you'll see that it did break down, in 2018. Hence, kind of taking out a pillar of the bearish bond argument. Doesn't mean that yields can't go up, but it means that if you were going to put a bet on, you'd probably want to weight that bet a little bit lower, right? Because one of the factors that you'd probably want to see in a rising yield environment has disappeared. But moreover, and I'll just talk about another factor that we would use to intersect that, we began to see financial conditions worsen. So we'll just approximate that with credit spreads, right? We began to see credit spreads begin to widen. Well, if you look at historically, there have been no environments where, bond yields rose substantially in an environment now where you had those two factors in your favor, right? And
Right.
so therefore, if you're bearish bonds, you might want to reduce that exposure even more, just from a probability standpoint, that your bet might not have as much asymmetry. But then, okay, if you add like another factor like trend's a good factor because the trend is your friend. That also began to inflect around about November, December of last year. So now you've got three things, right, that are not in your favor. So anyway, you guys are getting an understanding, but that's kind of the process that we use to determine how much risk we want to take in a given asset class. It's a very precise, probabilistic, kind of form of portfolio management. And then we do that over and over again across different asset classes, and then we create an ensemble. Okay, we just kind of, it just kind of filters into a total portfolio. And so that's why where that can be very valuable is during inflection points in markets, where the market might be completely one-sided on a trade, but you start getting variant perception in the underlying data. And that's what we're particularly good at, and that's our specialty.
Okay, so let's talk about the current environment. What are you seeing, and what are your models saying now?
So there's all caveats. We do run a tactical model, and I have personal discretionary views. And the discretionary views, the things that I talk about, should manifest in the models. That's kind of our approach, is that the models have to be a realistic interpretation of how we look at the world. That being said, I'm a human being, and I can be wrong. And that's why I'm a model-driven investor instead, because I'm wrong a lot, actually. You have many years of mistakes, as do I, Kevin.
Yeah, that's right. So you're already way ahead of most of Twitter by admitting it, though. Most of FinTwit, they get 100% of their trades right.
That's true. It's way different when you have an audited track record.
That's true. Yeah. Actually, you don't realize, but Raul and I were going to start the club of FinTwitters that actually have had mistakes. Because it's a very
it's going to be a lonely two of you that is going to be on there.
That's right, because everybody else is 100 for 100. Anyways, we interrupted. Let's let Shalin talk. Let's go.
So this is a chart that's been brought up by some other people, and it's a chart that we like a lot as well. But what I wanted to do was probably look at it in a slightly different way than I think that's been shown in a couple of charts that I presented. I tried to select a few charts in our library that were maybe a little bit different. So what I've done here is...
Sorry, 1 second. Can I interrupt for 1 second? For those that are listening, we're looking at the global PMI chart. This is basically the PMI, the manufacturing PMI of the global economy since 1998.
And I will add to that even further. Sorry, is that if you're listening to the podcast, make sure you register for the email, because we're going to attach this chart deck in the email, right? So people can review it even if you're listening to the podcast. Sorry, go on. Well, tell us about this chart.
So what it is actually is exactly what you just said, except what I've done instead of showing the actual kind of spot PMI is I've just done a 12-month moving average. Okay, and the reason I've done that was to smooth out, kind of the noise that might come with any individual print. And also, as you know, if you have a 12-month moving average, you can see visually how smooth the trends are, which is why PMIs are really interesting, is because of the smoothness, right? So once you're in a trend, you can kind of get an understanding of which direction the global economy is going. And so in this case, what we're showing, and it's very clear and probably not news to anybody, is that the global economy has been in deceleration. But what I've done is, as well, is that you've been in decelerations. We've been in decelerations in the past. That's not a new thing. But what we have found, though, is that when we're below certain thresholds, the risks of various asset classes and various styles of investing increase exponentially, right? And
And
so
so,
all
how do
I've
you
done is a
position
simple.
yourself on this? Like, what when you're structuring your portfolio, how do you defensively position yourself when you see information like this? How does that change your asset composition?
This alone would not be sufficient. So that's probably where I differ from some of the other macro traders, because they'll just push this out, right? And say, oh, look, it's 2012 and the economy is declining, right? Or it's even 2013, frankly, and the economy looks very weak. And yet, if you look at risky asset prices, they did very well during that environment, right? So we have to be very cognizant of not only the direction of the economy, but sort of the risk reward in risk itself. And we just tend to fall into, just given the nature of our model, we do tend to fall into the camp where if something's cheap, I don't care what's going on in the macro economy. And so we actually inflect our style to become a little bit more of a bottom up investor as opposed to a macro investor. So my point is sometimes macro works very, very well, particularly at large inflection points. And sometimes it can be very tricky, like in a 2013 or a 2015, when assets aren't particularly expensive. And here we go. Exactly. That's exactly right. So if you look at previous environments where PMIs were declining, in this blue line, what I've done is maybe a cyclical versus defensive chart. So all this chart is basically showing is the performance of a basket of cyclicals, okay, divided by the performance of a basket of defensives. And
Right.
I've ranked percentile, just in a percentile rank, right? So cyclicals have been doing really, really well for an extended period of time against defensives. You might be at the higher end of the range, and that's what happened in 2017. And likewise, let's go to like 2016. If it's been underperforming for a while, you'll see that it's going to be very low. And what you find is that this actually it does correlate, and it should correlate with the ISM manufacturing, which is kind of like the PMI index.
Right.
Okay. And
Right.
so what happens where the variant perception comes is when there's a spread, when there's a huge difference between the two. And that is kind of in the position that we're in right now, as you can see. And so what
Right.
that means is that what that means is that whereas in the past, the global PMIs were not necessarily as effective as an indicator, they should be today, actually, because what you find is what we find is that a weak economy is not sufficient, and expensive valuations are not, sufficient. But a weak economy with expensive valuations, that's a really toxic cocktail, and that's kind of the punchline.
Right.
Okay, I'm going to jump in here now. I've seen on Twitter that you're a 0%er, are you not? A little bit of a bond bull?
In the long term, yes.
Yeah. So why don't you walk me through why you think that? I'm always an open mind. I'm ready to hear the reason I'm wrong, and walk me through your bond bull argument.
Or the reason that I'm right. Which one is it?
Why don't you walk us through your bond bull argument? I'd love to hear it. I'm curious why you think bonds are U.S. bonds are going to go to 0%,
Okay.
just for those who knows.
Okay. So this is really there's a couple of more technical reasons, and then there's a more existential reason, which people can argue, all day long, but it really goes to the heart of the argument. And so in the short term, I think there's this next page should have a chart. There we go. The next one. Yeah. if you look at the spread, right? So it's a very simple argument, but if you look at the spread between European bond yields and U.S. bond yields, you see that by and large they've tracked each other pretty well over the years, right? And we've got 20
Right.
plus years worth of data here. What you have now, or at least what you had at the beginning of the year, was the largest spread over the last 20 plus years, and that spread, of
Right.
course, has begun to converge in recent months. Part of the reason is that despite the fact that European bond yields have actually fallen, they're so bloody low that you're hitting what's effectively a zero bound. Um, who knows? The ECB might go to -5 for all we know. But
Right.
in this topsy-turvy world, but you have to believe that the second derivative of changes is going to slow down, right? But with the U.S., of course, there's still plenty of landscape for conversions, and so therefore, just on that kind of simple spread argument, that's one reason to be bullish. Now, the more existential issue is how we define money. And I think that's where I just tend to fall into the bucket of people who believe that credit is money. Okay, so any form of credit creation in the here and now is an inflationary sort of trend, right? So if I take out my credit card right now, I don't actually have any income, but the credit card company is giving me $10,000, and I go spend it. I've pushed forward my consumption today for something that I won't be able to do on a consistent basis tomorrow, and that in and of itself is disinflationary or deflationary. So the more you push forward credit and push forward returns in a credit-based economy, the more deflationary that is, right? Because you've pushed forward spending, and that is ultimately bond yields will fall in that sort of environment because money velocity will fall. So that's kind of the fundamental issue with the economy right now, is simply that we've pushed forward so much demand vis-a-vis the credit, this kind of credit-based economy and very low interest rates that are perpetuated by central banks, that the outcome of that, it will ultimately be inflationary. I don't disagree with you, but people don't realize how the money multiplier and the credit multiplier works, and how, with respect to inflation and the other things that it affects. So that's
Okay.
kind
So
of the short answer.
right.
of
So
a very
that's a great answer.
complicated question.
I'm sure Patrick would be all over that. And then you weren't Raoul Paul bond bullish though, so you didn't tell us it was going negative. So you aren't the most bullish guy we've ever had on the air here. So the one thing I'll just ask you for one last question. Give us kind of your take about where S&P and like U.S. stocks are headed in the next, maybe let's say 6 months to a year. What's your thoughts?
It's extremely difficult. The whole rally this year has been a function of multiple expansion. That's a really tough environment to play because it's not really fundamentally driven.
Mm-hmm.
It's very difficult for me now. I've given this whole spiel about where bond deals are ultimately going to go, but I will say that the level of bullishness in bonds right now, and the overbought nature of bonds, and how CTAs, for instance, are positioned, probably means in the short term that yields are contained. Okay, and without it's been our estimation that the bond rally has been very, very integral to the stock rally, and without bond deals kind of having that bid in the interim, we think that could be pretty negative for stocks. So we're pretty bearish. I'm not going to give you the perma bear sort of target, but we do think that part of this multiple expansion unwind is going to be rectified probably in the next 6 to 9 months.
Okay, well, there you go. Oh, thank you so much for joining us. Why don't you tell people about where they can find more of your reading and what you do, and check you out on Twitter, and why don't you give people the goods?
Yeah, so Twitter handle is BodhiTreeCIO, BODHITREECIO. And our website is B as in boy, TAM.co. We've written a lot of research papers, which we share for anybody who's interested. One of those research papers, if you guys remember, was last December. We basically predicted, using some of the things that I mentioned to you, why bond yields will go substantially lower. And we actually predicted a global recession to hit by the third quarter of 2019, which, I'm not sure about the U.S., but I think that the rest of the world could very well be in a recession right now.
Okay. Well, thank you very much for joining us.
Thank you.
Also, if you want to hear more from Shalin, just make sure you join us for the After Hours segment at the end of the show.